Good afternoon, everyone. Thanks for being here with us today. My name is Emily Shatlett, and I'm a partner here at Fairport and Luma Wealth. I hope that you and your families are staying safe and healthy during this kind of crazy year of 2020, we'll call it. We're really happy to have you here with us for what is now the 5th program in our Wealth and Wellness series. It's been fun learning new things alongside of you, and especially in a year like this where self-care seems to be a necessity to bring just a bit more peace and light into our world. So that is why the Fairport and Luma team spent 2020 with an inspiration towards looking out for you, your family, and the whole part of you, your whole selves. We started with Jill Miller. She talked to us earlier in the year before all this craziness and working from home started. She talked to us about how to nourish our bodies for better brain health. We then heard from Dr. Kaysen and also Maria Zeman, who helped us to learn how to nourish our bodies for overall health and wellness. We even sprinkled in some fitness meetups before we weren't allowed to do that anymore because of COVID, and it reinvigorated my yoga practice. So for that, I'm quite thankful. Last month, my colleague Pete DeVito and I, we did a program where we hoped to nourish your minds a little bit around optimizing cash flow and tax decision making to better your wealth status. And today, I'd like to introduce you to my rock star colleague, Katie Sheehan. She's a CFA. She has a passion for wellness and fitness, impact investing, and being a pretty cool mom to 2 very cute toddlers. So we bring to you the second installment of our financial wellness presentation, where we focus on making the best decisions to accumulate, grow, and preserve your wealth. So as always, we really want you to interact with us and be a part of this. It's way more fun if you do. A few housekeeping items just to help you along so you can join in the fun. At any time, please put questions into the question box, which is at the bottom of the narrow panel on your computer screen. At various points, that panel may disappear, and if it does, you can always click the red arrow to open that panel back up. And please, again, interact with us, share your questions, even your comments and your stories. We want to hear from you. Another thing is we would highly suggest that you be in full screen mode during the presentation, because we'll be doing some polling. And when we do that polling, you may not see it if you're not in full screen mode. There's a couple of easy ways to do that. You should see a little open box at the top right-hand corner of both that chat panel I just mentioned to you, the question panel, and also at the top of the presentation. So a couple different ways to switch in and out of full screen mode, but we highly encourage you to stay in that. So with that, I will ask Miss Annika, who's helping Katie and I along today, to flip to the next slide. So I won't read this to you, but I'll just say Eleanor Roosevelt, truer words are not often spoken, but I think we probably all find ourselves sometimes falling into that wish trap, because we think it's easier to wish than actually goal plan. But quite honestly, it's pretty easy to turn a wish into a goal. The main thing is you got to get it written down, write down that wish, make it a goal, and then build a plan to attain it, a roadmap, so to speak. And that is your wealth plan. I call it a wealth plan and not a financial plan, because in our view of the world, this encompasses all aspects of your life. Money, it's a means to an end. Money is the tool to get you to where you want to be. It's not the end all and the be all. So it's really your wealth plan we're going to be focusing on today. So your wealth plan is your personalized strategy for accumulating, optimizing, protecting, and distributing your wealth. Today's conversation, we're going to focus on just one aspect of that, because if we focused on them all, we'd have you here for the entire afternoon. And although I know you'd love to spend the afternoon with us, that might not be too practical. So Katie and I are going to talk about accumulation and how to build a roadmap today. So with that, Annika, I'm going to ask you to flip to the next slide, and you're probably now going to go 2 ahead. All right, there we go. So from time to time, people invest money just to make money as opposed to looking at their goals. So the first thing we want to start out with for you today, and go ahead and flip ahead for me, Annika, is we want to start talking about your goals. And this is where we're going to start getting a little interactive. So I welcome you and implore you to please participate, share with us. So we're going to start talking about your goals today. We're going to move through your investor profile, which is 6 different areas that Katie and I will take turns focusing on. We'll start with your goals. We'll look at your time horizon. We will look at the circumstances that might either short-term or long-term impact and create a pivot in your strategy. We're going to talk about your tolerance for risk, which actually may have changed quite a bit in this interesting environment we've been dealing with over the last 6 months. We'll talk about tax considerations because I can't do a presentation without talking about taxes because it just jazzes me up. Then we're going to talk about your personal values. All right, next slide, Annika. All right, time to tee up the interaction. Just a reminder, all in the chat box, the long vertical box at the bottom, there's the questions and answers. We'd love for you, first of all, as we go through, if you have any short or long-term goals that you would like to share with us or ask us, how might I get closer to achieving those? By all means, share those in the questions box. But now it's time for a poll. So if we can tee up the poll, what we'd like to hear from you is, have you made any changes to either your short-term goals or your long-term goals due to the life-altering effects of the coronavirus? And yes, we know that sounds dramatic, but don't we all kind of feel like this has been a pretty dramatic period of time for us all? So please let us know any big changes that you've made. All right. Oh, my goodness. Now, that couldn't have worked out better. 50-50. So 50% of you have made changes to your goals, and the other 50%, nope, my plan is stable. I planned for something like this, and I'm all set. And by the way, they're both right answers. Don't feel bad if you pivoted during this environment, because what we'll talk about a little bit later when we talk about circumstances is oftentimes really unique circumstances, like, isn't this the best example of a circumstance? It changes your goals, and that's not necessarily a bad thing. Okay, with that, Annika, I'll have you move to the next slide. So time horizon. This is the second factor in this investor profile that we are building. And I think, as simple as it sounds, it's one place where people often tend to get tripped up. They think, oh, time horizon. Well, it just depends on how old I am. Well, I would say that maybe sometimes that is the case, and oftentimes that isn't the case. I know 80, 90, as a matter of fact, even a 95-year-old who has very aggressive asset allocations. And people might say, oh my word, why? Why would you allow someone who's 95 years old to have a very aggressive asset allocation? But the fact of the matter is his time horizon is longer because he isn't going to need those funds. Those are really, he has other sources and ways to fund his needs. And those are assets that he's really holding for 2nd gen, 3rd gen, and maybe even onto the 4th gen. And so really, in the scheme of things, his age doesn't drive the time horizon. It's really the dynasty of the money or the longevity of those funds, and that's a really long time horizon. So don't get tripped up by that. On the other hand, we have people that we know that are 40 years old that have some short-term goals that they really need to focus on. And so they have to look at a more short-term time horizon for at least a portion of their money. So again, don't let your age drive, let your goals drive. Always coming back to the goals. All right, Annika, next slide. So a longer time horizon, it reduces your volatility. You may be in a glorious position where you can look at a longer time horizon regardless of your age. you may be in a position where you actually have to kind of step back and look at a shorter time horizon. But a beautiful example of this is what we just went through. So as you might all recall, the market went a little wild in March, in case you missed it, and into April. And I would imagine that most people who had a pretty long time horizon and not a need for those funds were able to take a deep breath and say, I've lived through this before, I've seen it, I've done it. It's going to recover, whether sooner or later, and I can calmly move through this storm. Now, individuals who couldn't do that were people that had a short-term need that they knew they couldn't meet otherwise, and they had to worry. Is this market going to recover before I need to access those funds? I hope none of you were in that position, and I can say confidently, I don't think anybody that is a Fairport Luma Wealth client would be in that position. But at the same time, what we have to recall, and it's demonstrated by this chart, is the longer our time horizon, the more we can stand that volatility, and it has, lesser impact over a longer period of time. All right, next slide, Annika. Okay, so we talked about circumstances, and on this slide, I didn't put Corona, but that's a circumstance. But some of the other things that may come to mind when we think about circumstances that affect your financial needs. And by the way, circumstances is one of those things on the investor profile. So what are your circumstances? Gosh, it could be something like, I lost my job. And that is an often unexpected, hopefully short-term circumstance. But always those should be considered because they could create a need, not necessarily to completely revamp your plan, but to make a slight pivot. Another circumstance is I may have an ailing parent, and all of a sudden I need to provide a significant amount of care. I may even have to lend some resources. That is a circumstance that affects your financial needs. And it's all of those circumstances that you factor in that also impact your time horizon, your tolerance for risk. It may change as you go along due to some of these circumstances that affect you. You can't control them, but the best thing you can do is plan for something to go awry, because oftentimes things don't go as we plan, and make sure your plan can support that long term. And yeah, Corona's major circumstance. All right, so with that, I want to pause just simply to ask Annika, do we have anybody want to share any goals, any questions in the question box, anything that we want to address right now?
I do not have any questions from the audience.
All right, well, keep thinking of questions, guys, and send them our way. But with that, I'm going to turn it over to my rock star colleague, Katie Sheehan, mother of two. Kick it off.
Gee, thanks, Emily. Can you just come introduce me every morning to make me feel better about myself?
I'd be delighted.
And perhaps we should add global pandemic to the circumstances slide so that, we're covering all the bases going forward. You just never know what's going to happen. Emily just laid out a lot of the important foundational elements of your investor profile. So, you're defining your goals and your objectives, the many elements that kind of go along with that. So what do you do with that? Really, that investment policy statement or your investor profile that Emily laid out will be your guide to manage your investments to meet those goals. And the way to manage that is through asset allocation, as it says on the slide. Asset allocation is simply just the mix or the percentages of the different asset classes within your portfolio. And it really should be in line with your goals. As Emily mentioned, everything kind of comes back to that goals perspective. So that includes the time horizon needed to meet the goals. It's the circumstances surrounding your financial situation, as well as COVID, and your risk tolerance. So Annika, if we could move to the next slide, please. So you're going to find we like polls in this presentation. So we're going to have another one. And what I'd like everybody to do is just for a second, take a look at the portfolios on this slide and consider which one you would pick. There's no right or wrong answer here. As you can see, Portfolio A has the lowest average and best case returns, but also doesn't have quite as significant of a drop in the worst case return. On the other end of the spectrum, Portfolio C has the highest potential best case and average returns, but you can see there's a significant drawdown in the worst case scenario. So we'll go ahead and put that poll up. And which portfolio would you choose? So as a reminder, because we do lose those portfolios when we put the poll up, portfolio A, that was your lower average returns with a less pronounced drawdown in the worst case scenario. Portfolio B, somewhere in the middle. And then portfolio C offers that highest best case and average returns, but also the potential to fall more in the worst case scenario. So give you guys just a second to think about that. All right, it looks like the majority went right down the middle, portfolio B, and I'm not completely surprised by that. Sometimes it's easier just to stay somewhere in the middle. That's all right. Like I said, there's no right or wrong answer. What we're trying to show here, as Emily mentioned, first you have the longer your time horizon, the more you're able to withstand some of that risk, that volatility. But that doesn't take into account your willingness to take risk, right? So even if you have a sufficiently long investment time horizon, are you emotionally able to withstand a market dip? Oftentimes advisors may use a risk tolerance assessment or may ask you some questions to get a better understanding of how you actually feel in different scenarios and gauge your willingness to tolerate volatility. And to that, volatility from a basic definition is, just the swings in security prices or portfolio values, as you can see from the portfolios that are provided. And my favorite part of this area of the presentation is that, Emily and I get to be the examples. Emily's only a few years older than I am and maybe slightly closer to retirement than I am, but from an emotional standpoint, she's willing to take on much more risk than I am. So although her ability, the time horizon aspect, she may be able to take on less risk. Her willingness is much higher, and it can then lead to a more aggressive portfolio than I would even probably be comfortable with. My ability to take risk is pretty high, but my willingness doesn't necessarily match that sometimes. I tend to be a bit more balanced, a little bit more in that portfolio B, or even a slightly more growth oriented in my approach.
And can I just say, Katie, and I'm sorry
absolutely.
to interrupt you, but
Sure.
never is there a better time to test your true ability and willingness to accept risk than what we just went through or what we went through back in 08 and 09. That's a learning experience, hopefully not one that has been or had been too painful, but a great time to really test that. Am I steeled through this? Can I be comfortable in it? And if you can't, that's okay. Just plan for that.
Absolutely. I think that brings up a great point. When the market's going up, risk tolerance seems to go up with it. A lot of clients are, it feels good. Behavioral finance calls it recency bias. You remember the feel good growth of the market that you're in and think you can take on more risk. But really that true test of how you feel about risk is generally in those real life scenarios, as Emily mentioned. When the market fell, like we saw in March of this year, I think it was kind of an aha moment for a lot of people of maybe, we've seen this run up in the markets for years, and then all of a sudden it drops 30%. I think it was eye-opening for a lot of investors of, am I really willing to take on this much risk? So, I'd ask any of you if you're willing to share any of your stories from the recent drawdown. Did you have any aha moments regarding your own risk tolerance? Kind of back to that whole idea of did your goals change? Did your risk tolerance change? Please feel free to put that in the question box. We'd love to hear from you. And trust me, if you did, that's okay. You're definitely not alone in that. And Emily, I'm sure given you work with clients a lot, did you have any examples, just anecdotally that you would like to share?
I do and did. in both the recent downturn and also looking back to 08 and 09 downturn, which I'm sure we all remember. I think probably still too young, too new and sensitive to share necessarily examples from this round. But looking back to last round, Katie, do you want me to share a client story?
Absolutely, yeah, if you have one.
So I'm going to tell you a story from 08 and 09, and we're going to talk about Harry. Harry was an individual who we knew didn't have a really strong tolerance for risk. We had worked together on the investor profile. We knew that in order to support that comfort level, he's probably more like a portfolio A person, that what we needed to do was be pretty moderate to conservative in our approach. So Harry actually had about 10 years worth of his living expenses in bonds and cash. And that's what I would call his capital preservation bucket. So to us, that felt like, whoa. I mean, I don't think in my history, and maybe not looking back at all, can you go a 10-year period and see a consistent downturn. So if you've got 10 years worth of your needs in, cash and fixed income, you should be pretty golden, pretty good. Well, fast forward, it was March 6th of 2009 that Harry called me, Emily, and said, I've had it. This has been going on for so long, I think it's never going to end. I liquidated my Vanguard portfolio, and I think I'm going to ask you to liquidate my Schwab. Well, and I said, Harry, it is your money. You have the power to make this decision, and I am not going to try to talk you out of it necessarily, but let's just talk about some facts and see if maybe you might want to pivot on that decision. So we talked about the fact that even before liquidating Vanguard, he had 10 years worth of needs in cash and in bonds. Oh, okay, he kind of started to lighten up a little bit. And yeah, you're right, I remember that. So as we got further in the conversation, he says, well, I liquidated my Vanguard, so now I have even more. So you know what, you're right. Let's just not liquidate the Schwab. Well, and that gives all of us advisors a little bit of a heart palpitation, because if the market continues to go down, you may get madder and madder at us as a client that we encouraged you to do this, but we know the market's going to come back up, and we can be objective because it's not our emotional feelings around that money. Although we do feel a lot of emotion for our clients, so it really is. But ultimately, I don't know if you remember the grave details of 08, 09. I do, just because I work in the business. The market actually started ticking back up in an incredibly sustained way on March 9th. There was never an I told you so moment with Harry. We don't do that. There's no reason for that. We don't look back in that rearview mirror. So there was never really any strong discussion around it. But I'm pretty sure Harry was just very happy that he had stayed fully invested in that Schwab account, and it worked out really well for him. So I guess, what I would say, I don't even say don't be Harry. Well, that's got all kinds of connotations, but I'll just say simply think about the logic of how you built your plan, and in most cases, your plan will support your needs. And so you may not need to have an emotional reaction like that. So in that regard, don't be Harry.
Thanks, Emily. Annika, did anybody happen to share any of their aha moments?
Not yet.
Okay, well, feel free to share, guys. We'd love to hear from you. I think it keeps not just you guys more involved in the presentation, but it helps us too, give some faces since we're all in this virtual world. But we can move, Annika, to the next slide, please. All right, diversification. A very easy and efficient way to reduce volatility in a portfolio is through diversification. And if you're already a client of the firm, I am more than certain you've seen this graphic before. It's a favorite because it's such a great picture of how diversification works in asset allocation. This is the periodic table of asset class returns. And as you can see, there's some asset classes that swing wildly each year with performance. Emerging markets is a perfect example, and that's where we have the arrows going kind of up and down roller coaster ride. And you can see it's anyone's guess as to how emerging markets will perform from year to year. It could be up 79% in one year and down 18% a couple years later. it's an extreme example, but I think it really gives a good picture in the chart that the asset allocation in the beige white square, kind of in the middle, that's your balance portfolio. So it has, cash, bonds, equities, etc. And it stays right there. It's lowering the volatility that you're experiencing. You're not up and down all over the place. And, as the title of the slide implies, it really smooths the ride for your portfolio rather than, hanging 10 on some of those wild waves. It's just taking you down the course a little bit easier. So what does diversification look like? Well, again, it goes back to what are your goals? What's your ability and willingness to take that risk? There are a few ways, though, that you can incorporate it into your portfolio. And Annika, can we please move to the next slide? So from the top, you can diversify by asset class. And I'll give the classic examples. You have stocks, you have bonds, cash, and alternatives. And these each have different return and risk profiles that when you combine them, they provide a diversified asset allocation that reduces that volatility and helps you reach your financial goals. A portfolio that has a higher percentage of bonds or cash generally will be more conservative and have less volatility than a portfolio with a higher percentage in equity. But as you can see, there's several ways, even within those asset classes, to diversify as well. Within cash, there's money market funds, which typically have a little bit higher of a yield. Although nowadays, not much. You're not really making money sitting in cash anywhere. But you have also CDs, simply your savings account. Those are good examples of ways to even diversify your cash allocation. Within fixed income, there's a lot of different issuers that provide diversification. You have corporate bond issuers, treasuries, which are issued by the US government, foreign bonds from other countries, whether they're at the government level or the corporation level, and so on. And again, each of these will perform differently based on economic factors, the underlying issuer. So incorporating even more than one of those fixed income asset categories can reduce overall portfolio risk as well. And then in alternatives, which I think is a little bit newer and a little bit more nuanced than some of your traditional asset classes, there's still a lot of varying avenues. You have hedge funds and direct real estate, commodities like gold, which has been doing pretty well, but I think kind of ticked down recently. But alternatives generally provide a return profile that's not correlated with other markets. So it tends to perform better when equity markets fall, kind of providing a hedge of sorts for returns on the downside. Next slide, please. So similar to fixed income, you can really drill down into different categories of equity to achieve diversification, even if you're in an aggressive portfolio that's mostly equity, right? And this is where we get a little nitty gritty. So just bear with me a minute, but I think the tornado triangle we have going does a pretty good graphic representation of what I'll be talking about. So first, you can look at it by location, whether the corporation is here in the US, it could be international developed countries like Europe, or international emerging markets such as China. And each of these regions, each of these areas, in addition to the underlying countries represented in them, all have different growth prospects, right? They're all kind of in different parts of the economic cycle at any given time. And then there's also fundamental differences that can really provide a great level of diversification. You can then take it a step further and look at it from the size of the company based on its market cap or capitalization. That's simply just the value of the company based on the price of its stock times the number of the stock outstanding. And large cap stock, those are companies like Amazon, Apple. They comprise the well-known S&P 500 index. The top 500 companies. There's also mid-cap companies, small cap companies, and each of these market caps, tend to perform differently based on, where the US is in the economic cycle, among a lot of other factors. Right now, well, we have seen an uptick in small cap, and part of that maybe there's an expectation that, regulation will be going down. It could be, large caps have largely, no pun intended, been doing a lot better the past few years, and it could just be where we are in the economic cycle. So, again, drilling in, being able to diversify at that level. Then you can go even deeper, as you can see at the bottom of our triangle. You can look at it from the individual sector level as well. You have healthcare, technology, that also have those different profiles and industry growth prospects. again, each of these layers just allows you another level of diversification in your portfolio. You could do it at any varying level that you want, but at the end of the day, what you're really trying to do is, diversify the portfolio in line with your investment strategy to provide those varying returns so that, in different environments, you're getting kind of the different return profiles to smooth the ride on the journey to your goals. That was a lot. So we're going to take a poll so that everybody can take a breath. And we're going to pick another portfolio. We're going to leave the slide up for a few seconds because, again, we're going to lose days once the poll comes up. But this time, what we'd like for you to do is take a second and think through what we've talked about so far in terms of, how can you relate your goals, your ability to take risk, your willingness to take risk, combined with that diversification, and what does it mean for you? Based on that, please take a look at these and tell us which portfolio would you choose. Do you feel more comfortable as a conservative investor? And we can go ahead and put the poll up. I'll run through these portfolios as we're looking at the poll as well. On one end, you have kind of the fixed income conservative, which is, as Emily mentioned, it's more conservative. It's generally a small sliver of equity exposure to reduce your volatility, while also lowering that opportunity for high growth. It's a lot more in fixed income and cash. Or on the other end of the spectrum, you're all in and you're aggressive, with most of your allocation to equities, driving that diversification through different types of equity investments. Or, are you somewhere in the middle? Are you more balanced? Are you a little bit more growth where, it's more equity exposure, but not quite as much? And again, there's never a right or wrong answer. It's wherever you are in this journey. It's wherever you are from how able you are to take risk, your risk tolerance, how willing you are to take that risk really makes a difference here. Oh, wow. Okay. So we have a lot. Most of you are growth investors, and that's okay. I think especially right now, despite the dip, equities have continued to, come back pretty strong. And that's good, and again, it's just a reminder before we move on, and I keep saying this and I feel repetitive, but it's really to stress your investor profile is used to create your asset allocation strategy, the mix of the assets in your investment portfolio, and it's most appropriate for you. It's based on your unique needs. So just because, again, just because you're close to retirement, and think you should be more conservative, it's really important to look holistically at your financial situation and your risk tolerance to determine the best allocation for you. It depends on a lot of different factors, not just, how far away am I from, excuse me, I'm sorry, not just your age, as Emily had mentioned before. And before we move on, Emily, did you have anything to add in that regard?
I think what I would add here is that a lot of people, maybe from their gut or from what they read, think, oh, golly, I'm a retiree. It's time for me to be balanced because that's what the books tell me to do. But again, let's go back to that. This is all based on your own unique circumstances. So I can't tell you how many times I get that question of, well, so I'm a retiree. Does it mean I have to be X right now? And it's really not necessarily your age or how close or far away you are from retirement, as much as it's part of it. But even more than that, it is looking at your liquidity needs, looking at what goals you're going to be funding coming up, and making sure you've got that carved aside. And if you've done that and you've planned for unexpected circumstances, you may not need to pick one of these portfolios based on where you're at in your life as much as based on what feels right to you in your gut and supports your goals.
Absolutely.
So that's all I have to add.
Well, thank you. All right, Annika, next slide. And I think at this point, we're going to pause as well and see if we have any questions, comments, concerns from our attendees.
So one of the things about working from home, by the way, is my son just came and waved to me, so I'm sorry I'm not distracted.
I think we're all in the same boat, right?
Yeah.
All right, Annika, any questions?
Nope.
Okay, well then we'll just keep pushing ahead, guys. If at any time you need us to take a pause and answer some questions, feel free to send them in. So, we've already covered so much and we are not done yet. We went through your investor profile, what you're trying to accomplish, the roadmap to get there, discussed asset allocation, diversification. These are the tools to get you where you want to go on your journey, but really these tools won't do much if you don't stick to your strategy. It can be tough when you see the market down, 30% like we saw in March, but it's important to remember that you and your advisor agree to a strategy that would help you reach your goals no matter the market environment. So another poll, told you there's a lot of them, but this is a fun one. The average annual return for the S&P going back 25 years is 7.7%. Can you guess what that return would be if you exclude just the 10 best days in the market? We'll go ahead and put up the poll. And we have some options, so you don't have to take an actual guess. It's they're up there on the screen. Keep in mind, the average annual return for all days going back 25 years is 7.7%. What would that return be if you exclude just those top 10 best days? All right, so we're going to run through the actual answer before we move on to the poll responses, but go ahead and if we could show those, Annika, that'd be great. So for those of you that guessed 4.5%, you would be right, and we'll see how many of you guys got it. But gosh, how staggering is it that you lose so much in return just by excluding a few days? Oh, the answers were pretty mixed. All right. And you know what? I would have guessed any of them. I think that's a tough one, but congrats to that 27% that got it right. It can be tempting to react to market noise, panic, and sell just at the wrong time. Your return won't even keep up with inflation if you exclude the 30 best days over the course of 25 years in the market. And as humans, behaviorally, we're just really, really not good at timing the market. And as you can see, you can miss a lot if you don't just get it right. So sticking to the plan, trusting that your advisors set you on the best path to get you where you want to go. I think that's a really, really important piece of this. And we can move to the next slide. All right, the last point I'll make on sticking to your strategy is rebalancing, and we're not going to spend a whole lot of time here, but I think it's still an incredibly important part of helping you reach your goals. Over time, your portfolio allocation will shift due to the performance of the assets in your portfolio. As you can see in the slide, if US equities have done well relative to other asset classes, that weight in your portfolio can drift as it did here. It went from 51 to 65, and that's increasing the portfolio's exposure to a more volatile asset class, and that likely isn't in line with your strategy or with your willingness to take on that risk. So periodic rebalancing, it's really necessary. It realigns your portfolio with your goals, again, always driving back to those goals, as well as give you the peace of knowing your asset allocation won't keep you up at night with all of those market fluctuations if you're not invested the way you intend to be. Next slide, please. And last but not least from me is probably my favorite topic. Emily mentioned it from the get-go, and that's impact investing. This comes back to, defining those values within your investor profile and, figuring out if that's something that is important to you. Impact investing, it's aligning your investments with your values while earning financial return. Excuse me. So basically investing your money in a way that can drive environmental, social, and governance or corporate change. There's so many different terms and definitions when it comes to impact investing, but I think that's the basic definition. And what I'd really like everyone to walk away with today in regard to impact investing is that these strategies, those environmental, social, and governance or ESG factors, add an additional level of risk analysis in the investment decision-making process. Environmental, I think that's pretty easy for most people to interpret. It's pollution control, climate change. The S or social element has become even more relevant, especially in 2020 with, the COVID pandemic, as we've mentioned a few times. social injustice, really shining a light on how corporations are treating their stakeholders. And lastly is governance. That relates to things like board diversity and executive compensation, which I think has been around for a lot longer than some of these other topics. And so now we're going to have our last poll. I promise it's the last one. But how do you think impact investment strategies performed versus traditional strategies in the March equity market downturn? Did impact investment strategies outperform traditional strategies? Did they underperform traditional strategies, or were they neutral or in line with traditional strategies? And we'll go ahead and give you a second to respond to that. I'm getting jazzed about impact, but I know people are going to get jazzed when I pass this off to you, Emily, because I know it's coming next.
Oh, you do.
All right, let's see. Outperformed. Good job to that 67% that said outperform. It did. Studies have shown that by and large, impact investment strategies did what they were supposed to during that drop in March, and they generally outperformed traditional investment strategies. Keep in mind that a significant component of these strategies beyond, incorporating your values with your investment dollars, which of course is important, but it's a risk reduction. You're taking into consideration not just those typical elements of analysis like growth prospects, profitability, but also some of the exogenous factors like the likelihood of an oil spill or a data breach. So, environments where risk-off investments do well, like we saw in the spring, these strategies tend to stand out. I would also add, though, that historically, based on the structure of the strategies now, that use these ESG factors rather than just excluding entire industries, these strategies generally do as well as overall market with an inherent reduction in risk anyway. So, I'll come down off my soapbox for impact, but, if you do have any questions, this was such a brief overview. If you have any questions regarding impact investment strategies, feel free to reach out, use the question box, reach out after the presentation. Additionally, after today's webinar, if you would like any additional information or resources, reach out to your peer report team. They'd be happy to pass it along. This is a strategy that's really important to us, and really for me personally, it's a passion. So with that, I'm going to pass the baton back to Emily to talk about everyone's favorite topic, including hers. And I'm really not being facetious. Most people get really jazzed when we start talking about taxes. So I'll pass it back to you and see if we have any questions before we move on.
Yeah, Katie, we actually do have a question for you about impact investments.
Perfect.
Do we know how they have performed over the past 10 years?
Yeah, so as I mentioned, a lot of studies have been done, and I think it's been interesting over the past 10 years to see kind of the evolution of the product. Even 10 years ago, there was still a lot of product that was purely exclusionary. And what I mean by that is they would look at, energy companies and completely just exclude them just because they were energy companies. And that process has really evolved to be more of an integration. So you're looking at kind of the environmental, social, and governance factors in a holistic approach to gauge kind of where the risks are based on industry, based on the company, et cetera. And so they're not just automatically excluding some of those companies anymore. You might still see an ExxonMobil if they are investing in clean energy, if they're taking steps to do better, if they're really looking at their risk capabilities and so on. So that's the first thing I'd say. In terms of the performance, though, with some of the newer strategies, albeit newer, we've seen they have performed just as well as the market. Some cases better than, because especially with some of these active strategies, they're not just index huggers. They're out there actively looking for opportunities within this space as well. So they perform just as well as, and a lot of times, because you have that additional level of analysis, you're also reducing the risk. So on a risk adjusted basis, you're generally seeing these strategies do well. It's hard to blanket it because it's not an asset class like equities, or even, it's just another piece of kind of the investment puzzle when you're looking at it. So that's kind of my holistic answer. We do have some resources that support some of that. If you would like more information after the call, I'm happy to be able to pass that along.
And we do have one more question regarding the same topic. Does impact investing include venture funding, or is that a separate category for asset allocation?
I'm sorry, include what?
Venture funding?
Oh, okay. So it can, at Fairport, that's not something that we currently are doing. But I would say that there's definitely strategies out there, especially in the more of the alternative space, that include, venture capital for companies that are sustainable. It might be, more of the community development area that you might be interested. So there's definitely strategies in the VC space that kind of cater to this impact investing. And I'd say, the term impact investing really, I think, derives from that, right? Where you're making those direct investments and really seeing the impact that you're making as an investor directly. So yes, absolutely. And I'm so glad that we're getting these questions. I get jazzed about impact investing just as much as Emily gets jazzed about taxes. So did we have anything else?
Yeah, just got one more.
Perfect.
What are some examples of impact equities?
So that's broad, but I'll try my best. So there's kind of a couple different ways you can look at it from the equity space overall. So you can take it from a manager approach. So looking at it from mutual funds, ETFs, where you have kind of a professional manager managing your assets in that regard. Or you can look at it from an individual security perspective. From an individual security perspective, generally how that's done is, well, it depends. You can look at it from an ESG score. There's a lot of scoring vendors out there, similar to credit scoring that you'll see on the fixed income side. They'll give issuers an A, B scoring, kind of on a tier of what that looks like based on their profitability and so on. But this would be more on the ESG factor. So they're taking all of those ES and G factors and they're determining based on the company, the industry overall, et cetera, what that should look like and what that score is on a relative basis to the rest of their peers, as well as overall in terms of all companies. And so that's one way you can look at it. You can look at it from the perspective of how active is a company in some of this. How are they looking at their stakeholders? You can kind of do the due diligence yourself. What we recommend a lot of times is using an asset manager. They're the ones that are knee deep in this every day. A lot of them have their own proprietary scoring system that they're using that, really digs in deep. And what's important about using active managers in the space is not just them looking at the opportunities that are out there from, they have the ESG scoring, they're looking at the profitability analysis, but also really engaging at the management level with these companies of, if they notice there's an area they could do better and going to these companies and saying, here's where we think you can do better. And helping them come up with a plan to implement and reach those sustainable goals. I think that's a really important piece that, if you're just, Mr. and Mrs. Smith investor in a company, you generally don't have that say or that ability to do that. And so I think that's a really great part of active management is having that voice for you. I hope that answered the question.
Okay, we're good to move on to taxes.
Awesome.
Definitely, it's all you.
First of all, I will say I feel a lot of passion around impact investing after listening to that, Katie. So thank you.
Oh, thank you.
Second of
You're
all, I
welcome.
will say I'm incredibly jazzed up about the word exogenous. I'm going to have to find a way to use it. I don't know if the rest of you picked up on it, but that's going on my vocabulary list. So thank you for that, Katie.
It's my 30-point word for the day.
It's now mine. I am so excited to talk about taxes. So to the next slide, Annika. Now, I promise you all, we are not going to go into this in grave detail because we actually do an entire program on this. So I would have you here for another hour or 2 hours if I let my excitement get the best of me, and I promise I will not do that. But just know that my colleague Pete DeVito and I, we do a really fun program called Solutions to Optimization. We just did it last month. And it was taped and recorded. So we can actually share that with you. Reach out to your Fairport team if you're interested in hearing even more about taxes. And Pete happens to be one of the best co-presenters ever, besides Katie. And I really enjoy listening to him talk about his perspectives on taxes as well. And I think you would. So reach out to your Fairport team if you want to see that. But right now, we're going to do just a broad overview, talking a little bit about taxes, because yes, it does drive your strategy, your performance, a lot of factors. So it really is important. So we're going to talk about essentially 3 quadrants. The first quadrant, which is this one here on the far left-hand side of your screen, we're going to cover tax savings vehicles. And now I'm going to talk in buckets because my esteemed colleague, Ken Coleman, one of our managing partners, he loves buckets. And because of that, I think I've fallen into the same lovely trap. So there's essentially 3 different kinds of buckets of taxable savings vehicles, taxable and tax deferred savings vehicles. The one is obvious. It's what we call the taxable bucket. That bucket tends to be what you would call your investment accounts or your brokerage accounts or your trust accounts, things of that nature. And typically the investments in that taxable bucket are generally, most frequently, especially if you're being tax efficient, taxed at qualified capital gains rates, which are 15 and 20% respectively, depending on where you fall in the brackets. So that's actually a pretty efficient rate. Then you've got your next bucket. It's called the tax deferred bucket. That's our IRAs. It's our 401ks and 403bs. It's those types of investments that we invest pre-tax money, we save for many, many years with a tax deferral. That money gets to earn dividends and interest, and we sell and we buy, and there's no tax impact during that time. But as we start to take distributions from that money, the full distribution is taxed at your full ordinary income tax rate. And so those ordinary income tax rates can range anywhere from, call it 12% to 22%, all the way up to 37%. So that bucket, while it's a beautiful savings vehicle, if you've got too many of your eggs in that basket, you probably know where I'm going with this. And I'll wrap when I talk about the third bucket, which I personally like to call the holy grail of the buckets. It's probably one of the harder buckets to attain accumulation in, but it's also a beautiful bucket to have in retirement. And that is our tax-free or tax-exempt bucket. This is things like your Roth IRAs, your Roth 401ks, 529 plans, and HSAs. So in an ideal world, you are able to, as you save and as you move throughout your life cycles, balance your money in these buckets. Many, many people find themselves in the situation where they have an imbalance, where they have, say, for example, a lot more in their tax deferred than they do anywhere else. And while that doesn't seem so painful, once you get to retirement, that could put you in a position where you are in a equal to or higher bracket in retirement than you were back in your working years. So again, everything you can do to balance those buckets is really helpful. Next quadrant right in the middle there, let's talk about tax efficient investing. And yes, that is a thing. So there's certain types of investments that are more and less tax efficient. It doesn't mean that you should use only the more and never the less. But what it does mean is that asset location becomes ever so critical as you're dealing with these types of tax efficient or less tax efficient buckets. So let me give you a couple of examples. Tax efficient bucket. That would be things like your qualified dividend paying stocks. That's a tax efficient investment. Municipal bonds. That's a tax efficient investment. Now, I am not doing a commercial for investing in municipal bonds in this environment necessarily, but I'm just simply saying that's a tax efficient investment. Now, on the other hand, you've got your much less tax efficient investments. You've got your REITs, which pay and tend to pay interest type or non-qualified dividend type returns. And so that's less tax efficient than what we were talking about previously. Another, I guess, class of investments that tends to be less tax efficient is mutual funds, for example, versus ETFs. Because the fact is, when you invest in a mutual fund, the behaviors of all of your fellow investors in that mutual fund impact you. So if at year end, lots of people decide to divest of that fund, you get capital gains distributed. You get dividends distributed that you didn't necessarily drive or plan for. So I would call that less tax efficient. So what do? I'm not saying avoid those less tax efficient buckets, but what you try to do then is let's go ahead and combine or work together these first two quadrants. And let's say if I am going to invest in some of these less tax efficient things, to the best of my ability, I'm going to go ahead and try to do that in my tax deferred or my tax free vehicles. Whereas I'm going to try to fill my taxable bucket up with more tax efficient investments. And that's how you get these things, these two things working together for you in concert. So the last thing, see, I'm keeping myself very disciplined, even though I get so jazzed about taxes. We're going to talk about tax sensitive strategies. And specifically, I'm just going to focus on tax loss harvesting because, whoa, what a year to talk about tax loss harvesting. And I'm going to first say thank you to our whole investment team, John, Katie, Rick, Mike, and Aaron, for being incredibly proactive with our client accounts during the downturn. Usually I expect that myself, Pete, Tom, some of the CPAs, we're gonna have to knock on their door and say, hey guys, what a great time to loss harvest. But this year we didn't have to do that at all. And I think it's because we're all really starting to think in alignment about how to make sure that we are looking at all of these factors that really help to improve a client's long-term return. And so I want to say it was like March 8th, March 17th, and March 23rd. I could be wrong on the dates, but that's generally when I remember. The team really took an active approach to loss harvesting. And what that is, just to kind of refresh for everybody, it's not us freaking out and panicking out of the market and selling a bunch of stuff, but it's us saying, hey, this stinks. But during a market like this, we have some losses. And if you capture those losses, it can be an asset for use now and in the future against your gains. But we immediately reinvest in something that is not the same, that would create a wash sale, but similar. And so what we're finding now, I'm doing all kinds of tax projections with people and we're like, yay, we had a really painful time. We've already recovered. It's wonderful to be us, but in a market like that, if you didn't do loss harvesting back in March, you could find yourself come next April paying a really big tax bill on lots of capital gains. If you had the foresight to loss harvest and capture some of those losses, now you have losses to offset those gains looking both now and in the future. So it really is a beautiful way to, again, just be accretive to your performance and your return and help you reach your goals and make sure, you're making the best decisions around your money. So that is it for me with taxes. Next slide, please, Annika. I definitely won't dive into a lot of detail here, but just a few high points. So talking about the tax advantage savings vehicles, there's a few questions we get quite a bit. So, first of all, how much should I contribute? In an ideal world, of course, max it out. Of course, we want to build up that tax deferred bucket as much as we possibly can. To the extent you are not able from a cash flow standpoint, I would say make sure you contribute at least enough to get your match. And then have the discipline that as you're getting increases in your salary that you push more and more and more towards your retirement plan so that you find yourself eventually in a max out situation. And of course, start early, but just start. Even if you didn't start early, just start. Another question we get a lot is, as it relates to the Roth 401k, should I do it? Should I not? And there's a lot of people in the industry that would say, if you're in a low tax bracket, do it. If you're in a high tax bracket, don't. I don't really live in a black and white kind of world where there's a right and a wrong. I'm kind of more in that it's all about your own personal situation and what you're trying to accomplish. And I'll take you back to that whole bucket situation. If you look at your buckets and in your personal situation, you see that you're quite imbalanced towards lots and lots and lots of money in 401ks and IRAs and not much anywhere else. I would argue that even if you're in a higher bracket, start to push something towards that Roth option if your employer provides you with the Roth option in your 401k, because it begins then to help you to strike that balance. And you'll be closer to that balance as you get to retirement. Think about it this way. Tax rates are likely, and I'm not trying to make a political statement, but they're likely to go up from here. And so even if you are in a higher tax bracket, you could be in an even higher one later. So if you can take some time now to strike that balance, absolutely by all means do so. And if you have any other questions about that and want to dig deeper, reach out to your Fairport team. We really like talking about this stuff, so reach out to us. Last thing I'll say is 529 plans. We get a lot of questions on that. We've got our panks, our aunts that love to save money for their nieces and nephews. We've got our parents, we've got our grandparents wanting to contribute to the education of the children. What's the most efficient way to save for that? And these days, I would say 529 plans, you can't shoot holes in them, barely at all at this point. They're so flexible. You can save money into 529 plans for elementary and secondary education these days, as well as college. You can also use it for any and all qualified expenses, and so it's a great way to save. You put the money in after tax, you save tax-free, you distribute tax-free as long as it's for the qualified type expenses. The one other thing I'll say about this is direct investing, like with College Advantage Ohio, or through a broker investing. The only thing I will say to you there is, regardless of how early you start saving for a child, there is an inherently shorter time horizon on a 529 plan. So to the extent you can reduce fees, keep them at a minimum, that's just going to be accretive to your performance. So I tend to like going direct, especially when you live in Ohio or when you have an Ohio plan, which you don't need to live in Ohio to have. It's a beautiful plan. They have wonderful investment options. It's very low fees. Go direct, collegeadvantage.com, and sign up for your plan there, because you're going to avoid some of those extra fees you would get through broker.
And I would add, as a parent of 2 little ones, the website is extraordinarily user-friendly. It's very easy, and they can also give you codes if you have your panks or your grandparents that want to also contribute. It makes it really easy for it to not just be you, but everyone can kind of be involved in the college education funding piece. So it's my 2 cents on it.
Thanks for adding that 2 cents, Katie.
Sure.
So we'll flip the slide and we're just going to wrap it up here. We're supposed to tell you what we're going to tell you what we told you. You know what we told you. We helped you to think through the 6 tiers of your investor profile and how to make good decisions to really accumulate, preserve, and grow that wealth. Reach out to your Fairport team if you have any questions about that or you want to dig deeper. But what I want to tell you about now, and if you flip to the next slide, Annika, I think we've got some additional information on our upcoming wealth and wellness programming. So today you heard accumulation, and there's essentially four stages in this presentation. Next month, September 10th, we have our Solutions to Protection program coming up. That is my esteemed colleagues, Dana Hastings and Michelle Taylor, who will walk you through both some risk management type discussions and also looking at your insurance coverages to make sure they're in shape in all aspects. Also coming up, and I'm going to have to look at my paper for this because these are new and hot off the presses. We have a Medicare and a Social Security program coming up where we'll do a deep dive on each of those topics, which could be of great interest to a lot of people. That is, I think I have one of those dates wrong, but at least one of them is October 7th, I believe. So look out for that. Ask your advisors about it. Those are going to be great programs. And then finally, although I hope not finally, we might have one more coming that's not been scheduled, we have a sleep program. We have another program focused on your overall health and well-being. From the Cleveland Clinic, we have Irina Todorov, and I hope I did not pronounce that name incorrectly, and she's going to talk about sleep health, which I know I need because some days I'm good at sleep and other days not so much, and I'm sure a lot of you could concur with that. So we
I think right now everybody's in that boat, right?
Yeah.
We're all just trying to sleep where we can at night.
We welcome you. We'd love for you to join us. Keep in mind, all of these programs, we do record them. So if you can't make it, you've missed one previously, you've got one coming up that you can't make it to, please reach out to your Fairport team, your Luma team, and we will send you the webinar and you can watch it yourself. So with that, I'm going to thank everyone for coming and say, Annika, group, do we have any questions or anything we want to dig deeper on?
Yes, I do have a question here. Emily, how much can be invested into a 529 college fund?
That's an excellent question. Over a lifetime, you can build those up, and it really varies depending on the plan. So I'm not going to give you exact figures on that, but some plans actually max out in the couple $100,000 range. But more on a practical level, what I'll say is, as we're gifting to 529 plans, one of the big challenges is we have to have gift tax considerations in our mind. And so many of you may know that the annual gift tax exclusion, which is the amount you can give to any one donee free of any gift tax implication, is $15,000. What I will say though is the cool thing about 529 plans is they've put specifically an election in place. It's called a 529C, in case you want to know, where you can actually give 5 years worth of annual exclusion gifts and spread it out over those 5 years without having a tax implication. So we see many people want to front load that entire 5 years into the plan. And if there's two of you, so you're a married couple and you'd like to gift to your grandchild and you'd love to front load that so that it has lots of time to grow, you can gift up to 30,000 times 5 all at one time with no use of your exclusion amounts. That's just using your annual exclusion in the 529C election. But again, bear in mind when you do that, you are required to file a gift tax return to make that election and to report that to the IRS. And your Fairport team can help you with that too.
I don't think we have any more questions.
All right. Well, I guess what I will say is if any questions come up, you can always reach out to your Fairport and your Luma team. You probably know how to reach Katie and me, and if you don't, it's right here. We're happy to field any questions that you have. I'm hoping a lot of you want to ask Katie more about impact investing, and I'll be thrilled to answer any tax questions. So thank you so much for being here, for being engaged with us during this really tough time. It's kind of fun to connect with people, both virtually and otherwise, but it's tricky to do these days. So we thank you so much for your time and send you off with the wishes for a great weekend.
Thanks, everybody.